Are you considering the purchase of a business? Before you do, discover the mistakes that can make or break your venture. Even one mistake could cost you and completely change the outcome of your long-term success. Hi, I'm Trent Lee. I've sold over 600 businesses, and for the last 5 years in a row, I've been named the #1 business broker in the country for the most closed transactions per year. And I make these videos so that one day, when you think about buying or selling a business, you'll think about me. Mistake number 1, having insufficient cash to operate the business. Many buyers forget that working capital is a crucial part of success. Most small businesses come without account receivables or cash in the bank account, meaning you need to fund the cash or build up the working capital and manage the changes in the business day to day until you have that capital available to you, or ideally start with that capital. Part of your due diligence should be properly calculating the working capital. Don't get caught without enough money to operate. It could be a disaster. So make sure that this is part of your due diligence. Mistake number 2, not having competent advisors. Cutting corners with inexperienced legal, tax, accounting, or insurance advisors can lead to trouble. Your advisors don't need to be the most expensive, but they at least need to have relevant experience to guide you effectively through the purchase. I can't tell you how many times I've dealt with sellers who have a brother-in-law who is a divorce attorney who wants to help them handle the transaction. And guess what happens? Every single time, it ends up as a total mess, as a disaster. So whatever you do, make sure you hire industry-specific experts. Just because your brother-in-law is an attorney doesn't mean he's qualified or experienced in mergers and acquisitions. Mistake number 3, purchasing a business that doesn't match your skills and abilities. It's crucial to assess your strengths and weaknesses as an individual to ensure that the business you're looking at aligns with your background. Filling any skill gaps before buying your business is a key to your long-term success. I get calls every day from potential buyers who say they're industry agnostic, which I understand they have no preference on what industry they buy. They're just looking for a business that makes money. The problem is some industries require a particular set of skills or credentials or background. Even if you are not handling the day-to-day operations, you need to know enough about the industry to manage it remotely, and you can't do that well if you have absolutely no experience in that industry. Mistake number 4, let's understand what due diligence is. It's the process of carefully verifying what the seller says as far as representations and warranties, as well as financials. Now, why is this step crucial? Well, for starters, financial statements and tax returns can sometimes be misleading. Let's not forget the infamous case of Enron. Deceptive financial reporting can hide a multitude of problems. During your due diligence, it's vital to uncover any hidden issues. These could include outstanding lawsuits, judgments, unresolved customer complaints, product returns, significant warranty work that you might be responsible for, outstanding client gift cards for unfulfilled work, just to name a few. These issues, if they're not disclosed, can have a material impact on your ability to buy and operate the business profitably post-closing. Here's the key takeaway. You as the buyer need to take control of the due diligence process. It's your responsibility to ensure that your due diligence team investigates every aspect thoroughly. Now, let's talk about expertise. If you don't have the skills to verify the seller's statements, it's essential that you hire someone who can. This is an area where some buyers try to cut costs, but it can lead to a lack of clarity about the business's true condition. And let me give you a bit of advice. Your long-term CPA buddy who files your taxes using H&R Block probably isn't the right fit to do proper due diligence. So make sure you hire someone that's an expert in that field. Mistake number 5, not understanding the seller's motivation. Some sellers have hidden reasons beyond retirement, like changes or legal issues. It's essential to uncover these motivations. Are they burned out? Are they ready to retire? You need to discover what is truly the driving force for the sale to make sure that it's something that won't affect you. I just closed a transaction where the seller was tired of dealing with people. He found it exhausting, but the buyer loved talking and dealing with people. He found it exhilarating. So just because a seller's burned out doesn't mean that there's a problem with the business. Just make sure you find out why they're burned out to ensure that you won't be. Mistake number 6, not understanding your financial needs. Recognize that cash flow requirements of the business and your personal lifestyle needs. This is important. Small businesses often require financing, so plan accordingly. Make sure you have enough money to fund your operating expenses for the business, the future capital requirements, bank payments to service the debt, and then still have enough money left over to support you, your family, and the desired lifestyle. A mistake here could spell disaster for either the business or your family life. So don't skip this step. A due diligence expert can help you with cash flow forecasting. This is one of the biggest mistakes I see. A cash flow forecast will help you plan and stick to that plan. Mistake number 7. One common mistake to avoid when buying a business is paying too much. When it comes to determining the value of the business, there are various methods and formulas involved. The business's worth often depends on the buyer's plans for running it. Since these valuation methods can be quite intricate and rely on several assumptions, it's essential for the buyer to seek guidance from someone who understands these calculations. Usually, the seller's broker primarily represents the seller's interest. Unfortunately, some business valuation experts overlook crucial factors during their assessment. One key consideration would be whether the seller is willing to sign a reasonable non-compete agreement. Even if the other valuation methods and calculations seem to be accurate, in certain cases, the absence of a non-compete agreement from the seller can render the business's goodwill valueless or useless. In such situations, the business is only worth the value of the physical assets when liquidated. This emphasizes the importance of a thorough purchase agreement before making a purchase price. Now, you might be wondering why I use that example. Because I saw a buyer and seller try and do it on their own, put together their own contracts, and guess what? There was no non-compete agreement. So the seller immediately started a competing business and completely crushed the buyer. Mistake number 8. Failing to plan for a transition phase is a big mistake. This phase occurs after the sale, and it involves the seller passing on the necessary skills for a successful operation of the business to the new buyer. The duration of this transition period varies. For some businesses, it may be as short as just 2 or 3 weeks. But for a more intricate operation like manufacturing, for example, it often spans over several months. To ensure a smooth transition, it's crucial to include a detailed provision in the agreement. For instance, if maintaining customer relationships is vital, the buyer should specify that the seller must personally introduce them to the customers responsible for generating the revenue. If there are proprietary processes or trade secrets involved in a product manufacturing, the seller should document these before the transition concludes. Planning for these details can greatly contribute to the success of the business transfer. A good business broker will help the seller put together a transition and training plan for the buyer. If you aren't working with a good business broker as a buyer, you need to make sure that this is done and completed before you close the transaction. Don't close on it and hope it all works out without a plan. Have a detailed transition plan ahead of closing. Mistake number 9 is waiting too long to make an offer until you have all of the information. Many buyers make this error, thinking that it's a cautious approach. But here's the truth. If the business is genuinely good and it's a good opportunity, waiting can cost you dearly. You see, in the world of business acquisitions, hesitation often leads to missing out. So, what should you do instead? Your primary offer should be in the form of a non-binding letter of intent or purchase agreement. A non-binding letter of intent or purchase agreement is a powerful tool in the business buying process. It communicates your serious interest in purchasing the business while allowing for flexibility for you as the buyer. When you express your intentions early through the process of an LOI or asset purchase agreement, it opens the doors for negotiation and discussion with the seller. Negotiations can help you gather more information and insights to the business, which is invaluable for making a final informed decision. As a business broker myself, my advice is clear. Don't wait until you have all of the information. Act promptly with a non-binding offer, and you'll position yourself as a serious buyer in a competitive market. Remember, you'll make your final or formal decision once you get into the due diligence phase, and you typically won't get into the due diligence phase and gather all the documents you need to make that final decision without an initial offer. Success in business acquisitions often favors those who are quick to take action. And finally, mistake number 10, not considering the seller's family members as key employees or key positions. When assessing a potential business purchase, it's crucial to take a close look at family members who might be in the company. Here are some essential considerations. Sales role. If a family member occupies a sales role and is unwilling to commit to a non-compete agreement, exercise caution. In such cases, it's advisable to steer clear and explore other business opportunities. Another one's accounting. For family members involved in accounting roles and receiving fair compensation, their roles usually can be reasonably filled by a qualified individual with similar compensation. This can provide some flexibility. Here's another one, manufacturing or process roles. When a family member holds a pivotal role in the manufacturing or process-oriented business, exercise extra caution. It's crucial to evaluate whether this role is replaceable in case the family member departs. If you find yourself uncertain about the impact of family members in key positions, it may be best to pass on that particular business and the opportunity and explore alternatives with more clarity. Remember, a thoughtful assessment of the involvement of a seller's family member can significantly influence your decision-making process when considering purchasing a business. So, if you're considering purchasing a business, feel free to reach out to me. I'll help you through the process of analyzing the valuation and introduce you to the right experts that can help you step by step to get the deal across the finish line.